Yo, good morning. What up, what up, what up? Are we good? Everything's good. We're good. Monday, folks. Monday. Monday. That's how this stuff works. Getting everything set up. For those of you in TTI, the TTI scanner is officially live with the tracker and the market desk. We're going to be going through it in depth during the Market Blueprint webinar at 10:30. Please use the report button if you find any bugs. This next week is going to be, I mean, obviously it's publicly released now for members of TTI, but please do me a favor, use the report feature if you find bugs, because we want to get at minimum the scanner working efficiently before we continue to add on new things. There's a lot of products in the pipeline, as you can see. If you're looking at the stream right now, you're looking at kind of like a platform staging area that only I have access to. These are just ideas that I'm running through. Not all of them are going to make the final cut. Seeing what makes sense and what doesn't. Remember, the goal here is not to recreate FinViz, which is the greatest scanner of all time. If you're not using FinViz, shout out FinViz. I get no money whatsoever, although I probably should. I've sent them probably thousands of customers at this point. The affiliate program, right? FinViz is the absolute best. No reason to recreate FinViz. KoiFin, I can't go a day without using KoiFin for a couple of hours a day. This is the best kind of macro platform I've ever seen outside of a Bloomberg term. Shout out Godel, which I'm messing around with. I really like that. Godel scratches the itch of back in the days when you're in the fucking trenches with the boys and you're talking shit. You don't really get that nowadays. Nowadays, the world, a little bit more soft, a little bit more reserved. Can't really talk your shit. Back in the day, you used to get your fucking dick kicked in and people would laugh at you and make fun of you. And it was like the camaraderie of just, getting your ass kicked and coming back to work every day. I love that. I do. Maybe it's because I'm a little older. Godel gives me that itch, scratches that itch. Kind of that community where you can just get in there and talk shit to people and no one takes it. It's part of the game. It's the most competitive thing you'll ever do in your entire life. The most competitive thing you'll ever do in your entire life is trying to take money out of another man's pockets through the market. So, gotta be a killer. You gotta be a killer. I don't think there's any other way to approach this. Okay, so we're gonna go through that in about an hour and 5 minutes. Loading up the platform this morning, noticed a couple of different things. A slight pullback in some of the stocks that were running hot last week, but nothing to say that we're all of a sudden going to reverse back off of all-time highs. We had incredible closes. We went through this on Friday at the close, but we had some incredible weekly closes. If you're in TTI, go read the State of the Market report that Randy just put out. It's fantastic as always, but we had the S&P closing at all-time highs. The NASDAQ up there, not at all-time highs, but top portion of the range. I think we do get there. We just had this conversation at the beginning of last week. Do we think the Qs are going back to all-time highs this year? Yeah. Absolutely yes. How fast they get there is, anyone's guess. We could be there by the end of this week. We could be there by the end of, we could be there by the end of this session if we wanted to. It's not that far off. ADR 1.75 and we're about 2% off. Who knows? It could happen. Probably won't today, but could be this week. R2K went out at all-time highs. You had the Dow up near all-time highs. Let's see. We had microcaps at all-time highs, and we had, where else were we going with this? Mid caps at all-time highs. Equally weighted Russell 1000 at all-time highs. Equally weighted S&P 500 at all-time highs. Equally weighted NASDAQ at all-time highs. Not bearish. Just where do you want to park your cash right now? Where's the most amount of opportunity? So many people are focused on the Leopold Aschenbrenner stuff. Well, we've talked about this a lot over the last couple of weeks because it's like people are trying to snipe the buyback, the bottoms. They want the high beta stuff. It makes sense. It's fun. It's sexy. But the high beta stuff got crushed. Volatility works both ways. Probably going to need to see some sort of period of consolidation before the resummation of the uptrend, I would assume. Looking through something like an SMH, this doesn't look bad at all, but we're not quite there yet in terms of kind of giving the broad go command. We're still quite a ways away from all-time highs. I mean, it's a double-digit move. Doesn't look like it, but it is. Meanwhile, you got things like software that are breaking back out, coming up into potentially yearly highs here. You have internet stocks that are finally breaking out of the penalty box. A lot of opportunity in tech, maybe not so much in semis yet, unless you're willing to hold through the volatility. And if you're trading options, you really got to be careful with what you're looking to buy here, because the volatility can come back and absolutely crush you. Meanwhile, you have things like gold miners that are breaking back out, consolidation, pullback off of the January highs, consolidation, and then a re-break. Got energy, which we've talked a lot about in TTI this entire year, but we've started to reestablish positions over the last couple of weeks. We're very close to an all-time high weekly close in energy. Continues to look like we're going to get there. Little conversation yesterday about oil. Where does oil have to be for energy to continue its secular bull market? Last time energy was up where we're trading at right now, oil was up at 110. Currently trading 82 and it's still up there. Do we need to see a $250 oil to see energy, continue its breakout? Absolutely not. No. We made the joke on Friday. Haven't you ever seen Landman? You don't need $250 a barrel. As a matter of fact, that would be bad. $250 a barrel, probably not even energy stocks would be going up. Everything would be selling off at that point. Demand destruction, folks. Just because oil is that expensive does not mean energy companies are going to make a bunch of money if no one's buying it. So, kind of in this sweet spot right now. We just had a little bit of a tit for tat this morning between Trump and some of the other guys. Talking about, are they extending the MOU? And apparently, they are. I think Trump is now aggressively talking at Oman, potentially. I mean, we'll see. Who knows? It's not my game. I'm not here to try to figure out whether or not the game of geopolitics is going to be won or lost, depending on which side you're on. Just trying to make a couple bucks in the market. Energy stocks continue to look good. We went through this on Friday, live on stream, so feel free to go through that if you want a more in-depth conversation about it. We'll talk through it in about an hour. Over on the Market Blueprint webinar, but we have XOP and breaking out into 10 plus year highs. It's your higher beta area of the market to trade if you want energy positions. You have oil services, higher beta area of the market within the energy trade up at 8-year highs. Then you have a little bit slower moving transports and pipeline names in AMLP. I mean, there's a lot of different places and ways you can get exposure here if you want. Again, nobody wants to own this stuff because it's not sexy or fun. It's not in the situational awareness 2024 manifesto, and yet these things continue to do well. As a matter of fact, they continue to do so well that if you go and you look at sector performance going back this entire year. I mean, we talked about this on Friday, right? But here we go. Got energy up 41% on the year. Tech's up 33%. So energy continues to outperform tech on the year. It also is outperforming it, I believe. What is it, this quarter? Or is it not yet done it? It is this quarter. Now, this is obviously cherry picking a little bit because we've got the Leopold stuff going on. But energy is a place that if you're not looking for an opportunity to at minimum own an uptrend, I think you're doing yourself a disservice. And if you're using the TTI scanner, I mean, energy is all over this scanner for a reason, right? This part of the market is hot. You might not want to go and own all the things that are screaming higher. MPC is a fantastic name, but do you want to go and own it here? Probably not. Lots of opportunity outside of MPC, though. We own some of it. And of course, we're continuing to look. We filtered just through energy. You can see lots of different stocks here. One that I really like and I've championed for the last 2 weeks is Dino. Really like this Dino chart. See the 1 year price chart here, following all three moving averages up and to the right. It's hard to beat something like that. Match it up with sector and industry and flow, and you got yourself a nice little trade here. multi-year, what is this, about an eight-year high, all-time highs, but an 8-year base breakout, into all-time highs. Patented BRB pullback, breakout above resistance area, pullback, find support, bounce into new all-time highs. This is a BRB through and through. Lots of opportunity to own this stuff. Again, while everybody else is trying to go figure out the next memory trade, which is fine, let them do it. If you don't want to potentially sit and wait for the next, couple of weeks or months, who knows how long this stuff could take to consolidate. Energy stocks are there, folks. Right? Energy stocks are there. Also, financial stocks continue to look attractive. They continue to press their advantage up and to the right. Financials closing at all-time highs. You also have a little bit higher beta group in regional banks looking to finally close. And weekly all-time highs were very close. We have a position in KRE. We have a position in BAC. We're just trying to find the areas that are trending up and to the right within the right sectors, industries with some flow to back it up. This is about, not everything's great. We also own Citigroup, but we'll see if we get paid out on this, right? This looks good, but the trade right now is down. So while KRE is working well, Bank of America is working well, Citigroup not so much. You also have a JP Morgan here. How bad is the market when you got JP Morgan for the last 8 weeks just screaming higher? You have to ask yourself that. If you think you're smarter than the market, feel free to short this stuff. If you don't, and I don't, I'd rather follow it. Morgan Stanley looks good. Goldman Sachs continues to look good. Some good stuff here. Also, a point of emphasis, a lot of the 13 Fs, I think we should probably go through that on stream. In an hour, we'll spend some time, market blueprint stuff to talk about the 13 Fs that came out. I think that was some interesting stuff. Some not big bets, I guess, but some relatively surprising bets made in, you see Stanley Druckenmiller opened up PURR. Little hyper-liquid bet here. I'm also an owner of PURR, like a fucking dumbass, but that's all right. I got a long-term position in PURR. I made a couple bucks on the way up. We'll see if it starts to recover with the Druckenmiller pump. How about that? Also, we had Paul Tudor Jones, etc. What did he grab? Anybody want to refresh my memory? Did he grab just straight Bitcoin through IBIT? Some of the more risky guys are willing to go out and buy some of this stuff now, which makes you wonder, right? Makes you wonder. If the debasement trade is real, is Bitcoin finally going to respond? I mean, the debasement trade got put on the back burner for the last 6 months. I was in on 2026 debasement trade. We made a lot of money in silver, made a lot of money in gold over the last 2 years. Bitcoin was a flounder. And then Ethereum was like the canary in the coal mine at the end of last year. Ran Ethereum all the way up to over, 3,000 and then all the way back down as well. I mean, if the debasement trade, 3,000, nearly 5,000. We were long this entire move. I was also long for most of the backside fade like a fucking asshole. If the debasement trade is real, I would assume that you're going to see some liquidity come back into this part of the market. You can use something like a TOTAL to see if that's happening, and as of right now, it's not. Not bad, but not quite there. Paul Tudor Jones put it in IBIT. He's got over 680,000 shares of IBIT, increased his stake by nearly 19%. So that's a bet on debasement. I mean, it's hypothetically the same bet as being long gold and silver, just with a beta component to it, right? You would, well, at least I would assume, traditionally, historically, that Bitcoin is going to move more than something like a silver and a gold. But as we talked through, we've talked through this before, but check this out. The cycles are becoming less and less volatile in terms of Bitcoin performance. Everybody wants institutional adoption. Everyone wants to talk about that stuff. But as soon as the institutions actually get involved, regulations come in, etc., the opportunities for retail traders to have outlandish gains really just go down the toilet, man. I mean, this stuff, look at this. It used to move tens of thousands of percent per cycle, and now we're lucky to get 1,000, which is still, by the way, this is still a very important part of the market as a trading vehicle. The S&P 500 did not go up 670% in the course of 2 or 3 years, something like that. So this is still a very important area to park capital when it's moving up. And there's an opportunity here to own it when it's moving up. But are we going to go back, to the days where we see things like 10,000% moves in a cycle? Probably not. So for everybody out there my hands up, by the way. I was sucked into 2017 when the CBOE opened up Bitcoin futures, December 17th, not like I'm counting the day. And I was like, this is it. We're in, finally. Crypto is going to go mainstream. That marked the absolute top of that cycle, and ever since, the cycles have become less and less robust. So take it for what it's worth. I should have already known that, given the turtle trader stuff with commodities futures trading in the 80s. Once all the big boys got in and regulations came in, the wild, wild west of commodities futures tradings died down. A lot of the opportunity gone with it. Crypto's that going down the exact same route. I asked the question, what's the next great area of the market where there's going to be incredible amounts of inefficiency, where we can get in there and make outlandish returns before the institutions can get in? We know that, things like smalls and mids and even micro caps have some of that innately built in because of liquidity issues. You're not going to get financial institutions, for the most part, parking large amounts of capital in those areas because of liquidity issues. So retail still has some edge there. But what's the next great asset that we're going to be able to get into? I was joking about compute. Maybe. Maybe. Could be compute. I was just reading a thing over the weekend about how they want to bring compute on. We'll see. CBRS. Sweet. Yeah, we'd highlighted the CBRS pull back in towards a potential IPO-based breakout once we get back up and over 240, and we're getting there. So I don't think this is a big surprise, right? We talked about this live as earnings were about to kickstart, that the CBRS chain was showing, or pricing in at least, a very unrealistic opportunity for CBRS. It had to be greater than perfect, and of course it wasn't, so it got absolutely crushed. Implied volatility was already Xing you out. If you were going in there and expecting a bullish move higher, and you were one of the dummies that just went and bought straight calls, what was it, 200 IV with something insane with the IV rank? It's just nuts. So decided to wait, which was the right call. And now we have a fresh opportunity to own something at CBRS on a close above 240, with premiums literally cut in half on the options chain if you want to go with options. But you don't even need to go with options. I know this is going to hurt people's feelings, but you don't need to trade options on everything if you don't want to. Nearly a 12% ADR means this thing moves from a shares perspective as well. You can go and own some shares. Do I sound like a boomer by saying that? Own some shares. It's a double-digit mover intraday. Why not? Good trading vehicle. Good trading vehicle. So we had the dyno up. Let's see here really quick. Shameless plug. Go subscribe at the free Substack, tradinginitiative.substack.com/ty. Write something up. Let's go ahead and look at some 50-day high breakouts really quick. We're only 21 minutes in, so I'm going to go ahead and remove the RVol, or at least bring it down to 0.5. Go through some charts and order by sector. Quick look. This is something I do routinely throughout the day, is the 50-day high scan. A lot of these scans, but the 50-day high scan, I'll run through this probably 10 times in a day, starting from 15, 20 minutes after market opens all the way until basically right before I go to sleep, just to make sure, kind of a general pulse on the market. You can see which types of stocks are moving, but I particularly like to see what types of sectors are moving. That matters more to me than the individual stocks. You got the ETFs here. You got 22 names that are not oversold, optionable and shortable, over 1 million average volume. RVol, because we're a little early here, at over 0.5, and I'm looking at 50-day highs. As you can see right here, as we survey across the 22 names, look at the types of sectors that are responding well. You got energy, you got healthcare, you got industrials, and 2 tech stocks, One of the tech stocks that we were actually looking at that I think some of you guys probably own right now is Unity. Took a short-term burst trade on Unity up towards that 48 area. If we're able to sell that double on Unity, we can use that profit from the double to get ourselves into a longer-term Unity trade should it continue to break above this multi-year accumulation pattern. So using a short-term trade to finance the long-term trade. Perfect world, that'll work. We'll see if it does. See what else. A lot of energy on here, a lot of healthcare on here. Gold miners. We sold a double in NEM last week. So we have a longer term position in a gold miner, Newmont Corporation. We opened it up. We sold the double. We're able to hold this over the next 6 months. Should gold miners continue to work well, we cannot lose. That's the best part about. There's a lot of stuff that I was reading over the weekend. People are just so mad about options trading. Like, you got content creators that are like, you're an idiot if you're trading options, blah, blah, blah. I don't think the issue is with the options trading. I think the issue is with not understanding the trading vehicle itself and what it can introduce to your process. So if you're trading options like you're trading shares, obviously you're doing it wrong. It's not how this works. Options become a play either on the selling premium side, if you're looking to play probability and looking to play the idea that, volatility mean reverts, which it absolutely does. And, you go into the stats and look at something outrageous like 90% plus puts, for example, expire worthless. And like, you want to play that side, absolutely. But if you're playing the long side, meaning like you're buying premium, for example, and you're taking a directional bias like we do a lot of the times, it can absolutely introduce some pseudo leverage into your trades. But it all comes down to being able to protect your ass. Meaning, if you're putting 5 to 10% of your account to an options trade and you're not Chris Camille with Amazon, you're doing it wrong. The run rate on these things expiring worthless is very high. Even if you have the direction right, if you have the timing wrong, you're wrong. Even if you have the timing right and the direction right, if it doesn't move in fast enough, or if it doesn't move enough, through the implied volatility crush, you get, you lose. Lots of different ways to lose in the options market if you are a net buyer. If you're a net seller, there's lots of ways to win. That's why you'll see premium sellers win 90-95% of their trades, but those 5 to 10% losses are absolutely going to come back and crush you. It's all part of the game. So if you're looking to trade options with a directional bias, you have to understand, very basic Greeks. Like, it doesn't have to be anything crazy, but you got to understand IV rank. You got to understand implied volatility. Those are two of your probably biggest issues right there. The next thing is theta. Most people don't buy enough time on their options contracts to let their trade ideas play out. Delta, generally speaking, it's the percentage of probability that options contract will expire in the money. It's also directly related to the pricing on the contract for every dollar the underlying asset moves. The delta is how much that contract moves. So having a general understanding of the basic Greeks will allow you to build a better game plan when it comes to selecting the options trades. But my favorite part is this idea of convexity. Convexity gives us the opportunity to be able to sell doubles and remain in a trade completely risk-free, while, for example, if we have calls, the theoretical profitability in these things is infinite, right? There is no ceiling to a straight call profitability. So let's say, for example, Newmont continues to run. We have no idea how juiced up those call options can be. I mean, we bought January of 27, right? So we literally have through the end of the year. But we've already sold the double, so our max loss is 0. We can't lose. And our max profit is, infinite. What's the sign for infinite? This thing? Something like that. Not saying it's going to go to infinite, but let's say it goes to 200, 300, 400, 500. Systematically take profits up, either at predefined price targets or on a time-based interval, and just let these things go. The whole point is to try to capture the trend, right? So grab the NEM position for our gold miner, but there's a lot of different names in here that look okay, right? Agnico Eagle Mine. We owned this way back here at the breakout, and we made money all last year on it. Kinross Gold, we bought the breakout back here as well, just like AEM. Made money over the last year, on KGC. But all these look relatively the same. So how do you pick which one you want? I'll let you figure that out. But it's a concept called relative strength, and you do got to figure it out. Which one deserves your money, which one does not. Is KGC better than AEM? If it is, go and own it. Is NEM better than KGC and any AEM, etc.? Go and own it. But once you get the right area of the market, then you got to go and figure out which individual trading vehicle you want to use to be able to grab it. Very, very important. Okay, is there anything you guys want to look at in Discord? Any charts? CBRS is a good one. We'll pull that one up, Randy, during the Market Blueprint webinar. Again, if you haven't read through the state of the market, I encourage you guys to do it. Randy puts together probably one of the best and most comprehensive Monday morning takeaways. I really liked this one. He does a really great job at looking at volatility. Something that we're going to have him yap about 45 minutes. You don't need to do that, Randy. Hey, RWR. It's quite the move. Watch list. I mean, if you continue to want pharmaceutical exposure, which is not bad, we'll go through that later today as well. But momentum is slowing in ARWR, so there's a divergence in momentum up at all-time highs. I'd be very wary about whether or not this continues. I mean, the setup is valid, right? It's just a big rounded bottom with an all-time high breakout, but momentum is slowing. This is not a bad chart from a TA standpoint, but it's something you're probably going to want to hold back on for now. It's gigantic consolidation fractal. Throw whatever fib makes you feel better. $90 makes sense. Nice big round number. I don't think this is going to be in the... It is 87. Yeah, so momentum's slowing. That's the only thing. Bigger weekly base. Could be a recycled ticker. Either way, momentum is slowing. Obviously, I mean, the technical setup is very obvious. It's probably something that I would put on a watch list and then wait for a definitive break above 90. Arvin says, I bet AI could take the report that Randy writes, read it, and come up with an audio version. It absolutely can. Substack does that already. Substack has a built-in feature where it'll read you the articles. But here's the problem. When you're looking through like a Monday morning brief, and particularly with Randy's, it's super chart heavy for a reason. Like you have to be able to see the charts. So how would it make sense to have AI go in and read that report if it's chart heavy? Like, I don't know. If you can get the AI to describe the charts, go ahead. Chuck says SE. Yeah, I like the SE pullback. We're looking for a gap fill to the downside and then a potential resumation of this stage 2. This is one of the best questions in trading. So there's a gap, very obviously. Another 3 or 4% move to the downside, and it fills the gap. But you got some moving averages here that tend to act as dynamic support. You got your anchored VWAP from the 2025 high. You got the 20 and the 50 day that are screaming higher. What are the odds that this thing doesn't actually fill the gap and continues higher versus it does? And I have no idea. I can't tell the future. What I do know is if you want the stock, how bad is an additional 3% pullback going to hurt you? If it's tolerable, buy the stock. And then if you have a couple extra bucks as, dry powder, if it does close the gap, buy a little bit more down here, average a little bit lower, and that's it. Don't average any lower than that. It either fills the gap, it bounces, or it doesn't. Or if the pain of holding through a 3% pullback, which should not be bad, but for some people it is, you just wait for the gap fill. Issue is if it never fills the gap, you don't ever get filled. And then you watch it shoot off into the stratosphere, right? So to answer Chuck's question, is this a complete gap fill? No. But if you like the setup, which I love the setup, I think this is great, just buy it. Keep a couple extra bucks to average down if it makes you uncomfortable or you're a killer. But other than that, there's nothing wrong with this. Stage 1 into a stage 2, you get a pullback, found support at previous cycle high, right? Bear market highs, continuation of the move higher. Momentum is firmly in the bull camp with a cross back up and over the 0. You have bullish momentum regime. This looks totally fine. And then the best part is you go out and you look at the actual options chain. I think we did this last week. Plenty of real estate here to buy if you want it. You're below 50 IV with the 30.2 IV rank. You can go out into the Januaries if you want to grab the bigger trend. You want to grab something a little bit shorter. I don't really love buying Septembers here, but the Septembers are fine if you want to play it on a short-term basis. Octobers as well. I'm surprised to see this much action in the October. Generally, the October expirations don't have a whole lot of liquidity, but it looks like somebody was playing ball. Wow. Yeah, the scans are great. We're gonna be tweaking them as we go, obviously, but essentially none of this stuff is necessarily proprietary. Like I'm showing it on a public facing stream and there's going to be somebody out there that just like vibe codes the entire thing, which is already going to happen. So many people, I said I was having this conversation last week with a very large content creator and he has like his own scanner and stuff. And he was like fucking mad that people in his community were like stealing his shit. And it's like, dude, that's the future, man. That's it. Like people are gonna steal everything. And by the way, you shouldn't even be offended by it. Just it's gonna happen. People are going to see something they like and they're going to point their $20 a month Claude code at it and it's going to fucking recreate it. That's how this works. So you got to build a moat around, like, the software is no longer the moat, right? I had a different conversation yesterday with somebody about what is the new moat. The original person I was talking with, I said, the one thing AI will never be able to, at least not yet. I don't want to say never. The one thing AI will not be able to vibe code is balls. And I know it sounds so stupid, but it's true. Can you pull the fucking trigger when you need to pull the trigger? Can you do it? Like, oh, no, at least not yet. If you're a systematic trader, it's differently, but most people don't have the balls to execute. Walter Deemer says it the best. Like, when it comes time to buy, no one's going to want to. Like, you can't vibe code that. No one's going to. So, you could build the scanner, you could build the software, you could build the setups, you could build the systems, you could build the unusual options volume scanner, you can build all of this. It'll all get stolen in one weekend from some dude with a $20 Claude code thing. What he won't be able to do with it is trade it. He will not be able to do it. He might sell it, which happens frequently. Your shit will be stolen by people with bigger distribution than you, and it will be resold. So you have to prove that it works. You have to prove that you can use it. I've seen so many awesome things on Twitter, like vibe coded, and it's like, it's all, it looks awesome. But if it's not making any money, it's fuck all. And the other thing I was talking about yesterday, like, what's the other thing? I didn't really consider this until I had this conversation yesterday, but if execution is a moat that AI cannot vibe code, what's like the next thing? That data. Who has access to the best data? That matters. Who has it? I pay thousands of dollars a month for data, and I'm just one guy. Like, if you're not willing to go out and buy the data packages and like have the robust data set and everything else, like, it's all, again, who cares? Data is a moat. I don't know how much longer it'll be a moat. Somebody's going to come in and figure that out. But right now, data is a moat. So data, I'm on board with that. I think the guy that I was talking to yesterday, I'm not going to dox him, but I think he's right. And then 2 days ago, when I was talking execution, I think that's right. RAL is actually a name that we owned at one point. It was an IPO-based breakout, if I'm not mistaken. Yes, it was. We owned it. Yep. Little consolidation fractal here. Bada bing, bada boom. This is an aerospace and defense name, right? Not mistaken. Precision instruments and engineered products. Meta and Google have our data? Yeah, they do. They've had our data for decades. This is not an aerospace and defense name. It is held by tech. So this is a tech-related name. Doesn't have a lot of exposure into some of the larger... Actually, it does. I lied. Nearly 25% of this is owned by US ETFs. This is a fine name. There's going to be a lot of passive flow in here. Surprised. Volume shelf falls up above 72.5 if you don't want to wait for the 74.75 area breakout. 4.45 ADR. This gives you an opportunity to own a recently IPO tech name breaking back out into all-time highs. Let's see if there's anything on the chain. 18 IV is good. No one's playing ball in September. Some sneaky interest in November. When were these placed? Long time ago. Yeah, from an option standpoint, probably not. But from a share standpoint, absolutely. It's a mid cap. Did we say we consider this a small cap or a mid cap now? It's small cap. Small cap 4.45 ADR. How are consumer discretionary stocks still working? Well, let's look at it really quick. They're down right now. XLY has been arguably, I mean, this is going to be talked about for a long time. It's not talked about right now because of kind of what's going on with all the crazy AI stuff, but there's something to be said right now about the consumer discretionary sector not performing in this bull market. This has not been a good sector to own. Penalty box remains enforced. You got one of the most classic intermarket relationships between the consumer discretionary and consumer staples sectors, telling you to watch out, by the way. This is not good. People want to highlight it when it's going up and to the right. I get it, but it's not going up and to the right anymore. It's going down and to the right. It peaked in November of 25. If we look at it on an equally weighted basis, it's not just a market cap thing. Even on an equally weighted basis, it peaked in January of this year and is continuing to not perform well. So this is, this relationship right here, RSPD against RSPS, is effectively referred to as Wall Street's greatest fundamental analyst. So you got the equally weighted discretionary against the equally weighted staples and a drawdown since earlier this year. It's not the end of the world, but this is not what you would expect in a strong bull market. Yeah, traditionally 2 to 10 was mid cap, but that was pre-COVID. With the amount of money that's in the system now, I mean, we have how many $1 trillion companies? And it goes beyond just tech. I think, isn't Eli Lilly $1 trillion now? Over $1 trillion. So you got a healthcare company. JP Morgan was very close at one point. Oh, almost is. We have a financial name that's now going to be there. Technically, we have Berkshire. Almost there. So we have multiple financials, we have healthcare, we have tech. So it's not just like the Mag 7 now that are $1 trillion plus. So from obviously we're not going to change the descriptions. I don't know who the hell is the definitive person or organization that defines that, but I will say it doesn't make any sense to consider only 2 to 10 mid cap now. I would say 2 to 10 is small cap and anything under 2 is micro cap. And 10 to 25 is mid cap. Seriously. With the amount of money now, everything is inflated from an asset price standpoint. So also, if you want to define kind of what makes mid caps more appealing than small caps, it's generally because the company is turned a profit. So small caps and micro caps in particular are generally just debt-riddled pieces of shit. Most of them will never get out of being small caps. Mid caps are the vote of confidence on the small caps that maybe they've figured it out and turned a corner. And the holy grail, at least for me, what I found a lot of opportunity in over the last 17 years is not owning smalls to mids, but owning mids to larges. So back when the 2 to 10 was actually defensible, if you could buy a stock in the mid cap space and watch it eventually double or triple into the large cap category and start getting picked up by ETFs that only track large caps, that was awesome. Those wins were fucking great because then all of a sudden you got institutional, opportunities. Got ETFs passively picking them up. They come on to different scanner sets where there's a lot of people that don't want to trade mid caps because they've been indoctrinated that mid caps are too volatile or whatever. That's insane. Volatility is an opportunity if you know how to use it. It's not the end all be all. It's not this bad thing. So I think personally that expanding that universe, mid cap 10 to 25, smalls 2 to 10, and micros under 2 makes sense. You want to move it back and forth a couple billion or so. I don't think it matters, but so Jack. When I was out, prices are insane for stadium food. Notice people backing off $32 for a steak sandwich. They've always gouged the shit out of you at stadiums. But yeah, you're not wrong. Things are crazy. Things are super expensive down here in Brazil right now too. Obviously, I have the benefit of spending in dollars, but just so everyone's fully aware, and it's kind of a running joke, at least inside of TTI. It's not so much a joke to me, but you go and you look at like the dollar right now. At the bottom, I had over 20% of my purchasing power was just eroded over the course of about a year and a half, which is crazy to think about. Imagine this, like you have, I don't know, liabilities at $10,000 to $15,000 a month. And all of a sudden, like your purchasing power, those liabilities don't go down at $10,000 to $15,000 a month in Brazilian reais, I should say. And then all of a sudden your spending power drops 20% in a year. If you don't have on the other side, meaning like you make 20% or more, you lose a lot relatively quickly. And I have conversations down here sometimes with expats and stuff like that are down here working, or they're married or whatever, and they work for a company in the United States, they're remote. These guys didn't get 20% bumps in their pay to help them navigate like the currency crunch. So it's a big thing. I mean, right now it's up not quite a lot, but it's up a little bit. Still down 16% since it peaked in early 25, late 24, which is pretty crazy. I mean, again, I'm not necessarily complaining, because if the dollar is coming down against the real, it sucks for me, but it's good for Brazilians because they can go out and they can like buy things. Supposedly they can go out and buy things that are a little bit more affordable from the United States. But like down here, $32 for a steak sandwich, I guarantee people are still buying it. Maybe not as many. There's demand destruction there. It's a fucking steak sandwich for $35 or $32 at a stadium. Come on. But in Brazil, like if you want to buy, I don't know, what's something stupid, like a pair of Nikes, for example. A pair of Nikes in the United States, we'll say, is anywhere between $100 and $250. You want a pair of Nikes one weekend, most people can go out and swing it. Like it's, go and buy the pair of shoes. Most people are not going to have to save up for weeks or months to buy a pair of Nikes. Down here, a pair of Nikes can run over 1,000 reais, well over 1,000 actually. And on average, I don't remember what minimum wage is, but minimum wage, like they might bring in 1,500 reais a month on, not average, but like minimum 1,500. So imagine a pair of shoes is almost what you make an entire month. Like it's nuts down here. It's very difficult for people to get ahead down here. Very, very, very difficult. So I have all of the sympathy in the world. But I mean, this is a full globe thing, right? The United States is feeling it. Down here is feeling it. It's an election year down here as well. Elections start. The process is already going, but they have elections down here in October. And so like this is a hot topic right now. Very hot. Here's something for you guys out there that remember CDs. I was just talking to my mother-in-law about investment options. They have a bunch of money parked and they don't want to use it for over a year. So we were looking at different vehicles down here. Brazil is known as the land of fixed income, if you didn't know. So like unlike stocks, you can buy like investment vehicles such as bonds. They're not the exact same thing, but such as bonds down here, certificate of deposits, etc. And you can get 15 to 20% on a year down here through her bank. They were offering 14.5% on a 12-month lockup of their capital. Can you imagine that? Would you do it? Would that be a legitimate portion of where you would park your capital? Absolutely, yes. 14.5% on a year on capital that you don't need. Like we're lucky to get a pittance of that. And there are risks associated with locking your capital up down here. What happens if the government goes under, which is so crazy to think about, because I was having that conversation with my wife. I'm like, one of the only risks there is if the government blows up. And she was like, well, it did in the 90s. I was like, what? She was right. I went through and looked at it. Their currency blew up in the 90s. So like my mother-in-law and father-in-law lived that, where their currency basically went to zero, and everything that they had, they didn't have anything vested in the government at that point. But anything you did was like, good luck trying to get any money back. Those moments in history have built patterns into people down here. Like they do not trust giving their money away to banks and stuff like that because they have failed within our lifetime. So again, empathy and sympathy for that. Yeah, CBRS looks good. We're going to talk about it in 15 minutes. We made the right call not buying in post-earnings or pre-earnings, and now we're getting the IPO base break. A couple other ones we were looking at that we didn't pull the trigger on. Figma. Did Figma already report? It did. Figma, we're looking for a potential IPO base breakout as well. We had Figma. We had Cerebrus. We had, what else? Did we have Way? No. We had Via. What was it? I can't remember. Yeah, Via. There we go. We had Via. MMED. These are just off the top of my head. We'll scan through this really quick, and then I'm going to hop off the live stream, public live stream, and get on over to the private live stream where we're going to go through all this stuff a lot more in depth. Let's take this back to 5 years to get the good old stuff. Only 9 names on the list this morning. ANGX Entertainment. What is Angel Studios? That does not sound good. It's like an OnlyFans thing. Value-based distribution company for stories that amplify light. Teammates, you want? What is this, horse shit? Here's one. Looks like we were already yapping about it. NIQ, Global Intelligence. There is an overhead supply zone at $20 that we could potentially own the breakout of. That looks good. Man, this does not look good yet. I like the NIQ trade, not quite yet though. SGMT. This isn't bad from a pharma standpoint. Do a little more look on that, but it's out of the list right now. I think I like NIQ the best. Not to buy yet, but you can see that there's a volume drop off of over $20 at the all-time high area. Clear 1975, and we're up into big blue skies. This is not a bad little setup. Global consumer intelligence company positions at the nexus of brands, retailers, and consumers. It's a good description. It's all the buzzwords. Just needs AI. No way. Anybody still use Webull? Is this a thing? Dude, Bull might be a thing. Maybe. Thinking about the broader idea of these companies that are making money based off of trades. Earnings report in 2 days. Might be a thing. Man, there's a lot of names on this list that we've traded over the last couple of years. A lot. Some great trades in here. Some fun stuff. List is a little sparse though this morning, that's for sure. A little sparse. All right, I'm going to hop off and get ready for our private session. We're going to be going through the Market Blueprint webinar where we look at everything using our top-down model and look at some potential flow trades that we want to put on. We put on a couple of them over the last few weeks. A bunch of them have already hit. We've sold some doubles in them, so continue to see the momentum in those new trades. Let's talk through some of the new themes that are emerging, like this precious metals trade. What happens with Bitcoin if precious metals continue to turn? We're going to be going through the TTI scanner. Officially went live last night for all paying members, so it's an exciting time. Talk through all of the different stuff and also the different features that we're going to try to bring to the platform. That'll be cool. If you're not already a part of TTI, link is in the bio. And if not, just subscribe to the Substack. I write good shit for free. It's fun. The tradinginitiative.substack.com. Read through some of the stuff that I've already written. If you like it, subscribe. It's free. If not, that's all right too. Appreciate you guys. Thanks for hanging out with me. If you're in TTI, I'll talk to you in about 10 minutes. If you're not, I will be back later this afternoon for our second Yap session of the day.